What kind of recession do we need to see to get to that base case that you have of 3,000?
Yeah, first, that's not our base case; it's our bear case. Our bear case assumes a recession. We're still not quite there yet. And what it really accounts for is a mild recession. It does not account for, a financial crisis or some sort of big accident on the back end of this, because that's not really how we're set up. Meaning, the banking system is very secure. There is a lot of capital still out there, even in corporates. Right, the consumer balance sheet is actually in decent shape. So it'll be a mild recession if we get one, and we think the odds are increasing for sure into later this year, next year. And so, we can get through that. And the 3,000 target really does not assume a deep cut. We're assuming about $195, $200 in earnings for next year. That's what a mild recession would bring. And then you take a multiple of about 15 times on that. And that's how you get to those numbers.
No, fair point. And I'm sorry about the bear case versus base case. How much percentage now would you give to that bear case if you do see the recession odds end of this year, early next year increasing?
Yeah, so typically, when we do this framework, the bear bull base is usually sort of 60% base, 20% on the tails. And no doubt that the downside case is increased in probability. It's probably something like 50% for the bear case now, probably 35%. I'm sorry, 50% for the base case. I apologize. 35% for the bear, and 15 on the bull. And the bull really is getting pretty unlikely. The bull case is sort of this Goldilocks outcome. Seems unlikely, but we'll adjust our targets, and that's what we do. It's probability adjusted. The reason we wrote the note this week, Alex, is because, as you've been saying in this segment, that's the number one question we've been getting from clients. So we just wanted to put a framework around it for them, how to think about it so they can, invest appropriately. Because look, we've done a lot of price damage, right? We want to be investing into the price damage, but we think it's premature if the risk of recession is still increasing. So therefore, as you move further away from, say, 3,500, which we are now, 3,800 is kind of where we are today, the risk reward is pretty poor. And that's really the bottom line conclusion. We're trying to kind of thread a needle here, and we're never going to call the bottom exactly. What we're trying to do is put risk reward framework around it for clients so that they can take the proper action at the right time.
Well, what's so interesting to me is the ferocious move in the bond market. In many ways, sort of the selling pressure in the bond market and higher yields had already happened in the last couple of weeks. I mean, just today we get this terrible PMI number out of Europe and the UK and the US, and we see an enormous rally in the bond market. Yields really lower. 3-year yield now 20 basis points lower. And I wonder what you think the reaction function is going to be from the bond market to the equity market when we seem to be front running a lot of this.
This has been one of the things we've actually underestimated this year. We started buying bonds in our asset allocation back in April, thinking the worst was kind of behind us. That the bond market had already priced in the recovery as far as it was going to go, and we underestimated how far 10-year could go. So in some ways, we saw an overshoot. This is kind of resetting back towards 3% on a 10-year, which I would say kind of reflects more of our fundamental outlook, quite frankly, and on our general view that the Fed has probably already done enough to slow the economy enough to kind of achieve their goals. Either we're going to get a soft landing or we're going to get a recession. It's one of the two. But I mean, look, mortgage rates at 6% is kind of all you need to know to suggest that the Fed's already gone far enough to slow the economy in a meaningful way.
So does that mean, base case, you guys don't expect more rate hikes, or just not the kind of 75 bips that the rest of the market is expecting?
No, I want to make it perfectly clear. I mean, we expect the Fed to go forward on its path. We don't think they're bluffing on that.
Okay.
However, I would strongly suggest that the market is pricing in the continuation of that lasting longer than what reality is going to be. In other words, I'm skeptical as to whether the terminal rate is really going to be 350 or 4%. I think it's going to be well below that.
Okay, fair point. So then let's get to the equity allocation in this. So how do you make money then in this environment? A, how do you protect yourself? And then what do you buy on a discount?
Yeah, so we've been positioned defensively all year, as you noted. I mean, we've been probably more bearish than most. It's worked quite well. There's two things that have been working this year: defensively oriented stocks and energy. We've been more neutral in energy because of what's happening now, right? Energy eventually is going to figure out that growth is slowing too, and actually the crude market does not look particularly good to me on a technical basis. So I think energy looks a little bit dangerous now, and we're going to fare back into those defensive areas. And quite frankly, we may see a bid back into some of the high quality, longer duration growth stocks if rates come down here. Okay. because recession is not inevitable yet. So we may see people come back into trying to buy these, higher quality, large cap tech names if rates are coming down in the absence of evidence that a recession is imminent. We think that would be a counter trend trade, but that could work in the short term. And then the real factor that's working, Alex, is operational efficiency. What the market's paying for right now is companies that can deliver on cash flow and earnings in this difficult environment. And so that's a factor that we've been tracking closely, and it's working quite well.
Yeah, Mike, let's dig into that, because you guys did a screen for that, because the rhetoric is that we're going to have to see earnings downgrades because of margins. Like sales can hold up, for example, but the margin pressure is just too great, and then you're going to see the downgrades. What does have that pricing power, I should say?
It's not even about pricing power so much. It's more about who can just get the sales in the door and then to the bottom line efficiently. So the companies that screen well are ones that have low inventory to sales growth, low CapEx to sales, and then low employee costs as a percentage of cost of goods sold. I can't name names specifically here, but basically it's not quite a quality screen. Once again, it's more about companies that are being very judicious with the revenues that are coming in the door and doing a good job of managing the business. And so that can be companies within the same sector. Quite frankly, there's better operators, and those are the ones that are working right now.
And last question, Mike, as you look at the market and the tumultuous few months that we've had, where are we already pricing in your base case? Like, where have equities been hit hard enough?
Yeah, that's what we're trying to figure out now. We've been most bearish on consumer goods, consumer cyclicals, some of the technology complex, because that's where the over-earning was the greatest. But let's be honest, those stocks have come down quite a bit. So I don't think you can make a wholesale call yet on either sector, but there's absolutely names within those buckets where we're looking for are stocks that have not only seen a price degradation, but have also seen the earnings come down. We want to see both. And I think the third factor is they've got to be profitable. Right. We don't think we're going to go back to this environment for any time soon. Even if we avoid a recession, or even if we have a recession and recovery, we think this era of paying up for kind of profitless growth, that's a trend that's not going to come back in favor. And unfortunately, there are a lot of those types of companies in the technology space. So you got to be really careful with that. I would say one area that looks getting close, like home builders, are trading with very low multiples. If rates are going to start peaking out here, you want to be buying home builders into a recession if it comes. So maybe it's a little bit premature, but some of those things are looking kind of interesting to us just on valuation alone and the damage that's already been done.